Hi, today's video would be about inflation. Inflation has been a very trendy topic in the news recently, and you might be wondering what it's all about. So this video will help you understand what inflation is and how it affects your money. If you find my channel useful, please don't hesitate to subscribe. First of all, let's define inflation. Inflation is the rise in prices over a given period of time. So let's have a closer look on how it works. So to understand inflation, let's take a shopping trolley as an example. So let's assume that today to buy this all the food in this trolley, it costs you $200 at the store. Now, next year, if you were to buy that exact same trolley, it costs you $220. The $20 difference is inflation. The inflation rate is 10%. So the value of your dollar decreases over time. You can buy less with it. You might be wondering how inflation is measured. Each country will have their own methodology, but broadly speaking, they all follow a similar approach. In the UK, for example, the main inflation measure is the CPI, which is the Consumer Price Index. And the government basically every year define a basket of goods and services that are representative of what people spend their money on. And each month, they will gather price information across the country and across many sources, internet and physical shops. And they will calculate the price of that basket of goods. And say from one month to the other, if it moved from £100 to £101, then the inflation rate is a 1% increase month on month. If you want to have a look at what the basket comprises, here is a table of the main categories that make the CPI for 2023. And if you want to zoom in into the food category, for example, here are the types of goods that are included in the basket for calculating inflation. So you might be wondering why inflation is in the news so much these days. That's because the inflation rate is high, and high inflation rate is bad for the economy. The reason for the recent spike are multiple. One of the main reasons was the reopening of the economies after the pandemic. That created a big surge in demand, and a big surge in demand put pressure on prices. Likewise, the pandemic had created various supply shortages, and if there is less supply, the prices tend to increase. Another very important element was the rise in energy prices. The war in Ukraine has dramatically reduced the supply of gas because Russian gas was banned, and so all the European countries had to look elsewhere to go and buy gas, which pushed energy prices higher. If you want to know more details about how it works, let's look at the next section. So, some of the common drivers for inflation are a rise in demand, for example. So if there's more demand for goods and services, companies will raise the prices. There's more demand, so they can raise prices, which leads to inflation. Another common element will be issues with the supply chain. So if there are shortages in the supply chain, then you'll have less goods and services available. So prices will increase. Again, that's inflation. Now, when inflation spikes dramatically, you have another stage to it. It's when people realize that their money doesn't go as far anymore all of a sudden. And what tends to happen is people will ask for salary increases. So you may have unions, you may have strikes. So people will want to have higher salary. But what does it do? It raises the production cost of the company because now they pay more for their worker. So what companies will do, they will increase their prices because their production costs are up. And when the prices are rising, again, that's inflation. And that creates a vicious circle because now people will again fall back behind and ask again for more money. So you potentially have a vicious circle. And that's why governments and central banks are very keen on controlling inflation. Central banks have a target inflation rate, which is usually around the 2% mark, and that's thought to be a healthy level for inflation. But when inflation spikes, like we currently have, central banks have to raise interest rate to try to bring the inflation rate back down. So let's have a look at how central banks' action can impact inflation. If we look back at the financial crisis of 2008, banks around the world lowered interest rates to help support the economy. So this is how it works. So the rates go down. What does that mean? That means that mortgages and loans and other credits become cheaper. So people can borrow more money and companies can also borrow money at a very cheap cost. What this does is that it pushes demand up, whether that's demand for houses, demand for goods and services, and also investments by company, so that it helps support the economy. But one of the risks of low interest rate is that it can cause inflation. So if you now fast forward to today, central banks are pushing rates up, and that's because we have a high inflation at the moment. And by pushing rates up, they move the borrowing costs for mortgages, loans, for companies. All of that goes up. As a result, people and companies spend less money, so there is less demand and there's less investments. So that creates less pressure in the market, which brings inflation down. But one of the risks is that it might also stop the economy, it might slow the economic activity down. And that's a fine balance for central banks. So here's a graph of the Bank of England base rate. And you can see that it has been very low for a long time. And with the rise in inflation, now the interest rate is going up. The central bank is trying to fight inflation. But as you can see, that rise is very dramatic, and that can cause issues for the economy. And so talking about the governments and central banks' actions, so the way they regulate inflation with interest rate is encouraging an increase of money supply or reduction of money supply. And as you can see here, between the mid-70s and now, the total money supply in the UK has risen dramatically. And the same applies to other countries like the United States. And if the money supply increases a lot, considering everything else equal, then the value of the currency will decrease. So if the money supply increases much faster than the rest of the economy, then that currency will devalue. And to push this example to an extreme, if, for example, tomorrow every citizen in the UK was to receive £10 million on their bank account, then all of a sudden the pound wouldn't be worth quite as much as it was the day before, simply because the government has printed a lot of pounds. And that's what happened to a lot of the major economies, is governments have printed a lot of the currencies, and the value of those currencies has decreased over the years. So here's a graph that shows the purchase power of the pound between 1975 and 2015. So £100 in 1975 will now only be worth about £13. So the value of the pound during that time has decreased by almost 90%. And so if we move to an area that's often of interest, is the house prices. And the average prices of properties in the UK have increased dramatically between 1974 and 2023. You can see here on the graph that in 1974 the average prices were about £9,000, and in 2023 the average price is just under £300,000. And so here's also an important element, is that we're talking about the highest prices based in pound. And as we've just seen, the value of the pound during the past 50 years has dropped dramatically. The pound has lost much of its value. So it could also make sense that house prices are higher now simply because the pound itself is worth less. And that leads to another interesting graph that's coming very soon. If you were now to consider house prices in a different currency, for example in gold, then the picture might actually be quite different. So using the government data, I've put this graph here where I look at the average house prices in the UK between the mid-70s and now. The blue line are the prices in sterling, in pound. And the green line are the same prices but quoted in gold. And you can see that if it's quoted in gold, house prices have been quite stable over the past 50 years. So in 1974, the average house price would have cost you either £9,000 or 154 ounces of gold. If you fast forward in 2023, the average house price costs £288,000 and about 185 ounces of gold. So as you can see, the house price based in gold hasn't changed that much. And so the currency is one of the other big factors for inflation. So we discussed earlier about things like demand and supply shortages, but the currency, if the currency loses its value over time, then that also becomes a big driver in explaining why prices are rising. So what does this mean for your money? Well, when inflation spikes higher very suddenly, like we've seen recently, you feel the pinch straight away. Going out to the restaurant, going to the grocery store, all the bills become more expensive suddenly. Similarly, with the energy prices, the bills of many homeowners have gone up dramatically. In the long term, inflation can have a much more dramatic effect. So let's have a closer look. So here I calculated what would happen to £10,000 over the next few years if inflation was to remain at 10%. So if you had £10,000 and you left those in a saving account without interest, or if you just kept it as cash, you would lose half of your money, half of the value of your money over the next 7 years, simply because of inflation. So your £10,000 will only be worth about £5,000 within 7 years. That's how powerful inflation is in the long run. Also note that your wealth will still go down even if you received interest or dividend, as long as your wealth increase at a rate that is slower than inflation. So if you earn less than the 10% in this example, then your wealth will still go down. Well, I hope you found this video useful. And again, if you find the channel useful and interesting, please don't hesitate to subscribe.